Good day, everyone. My name is Mary Joyce Nicole El Manalo, and I'll be presenting Chapter 12 of Food Service Management titled The Menu and the Financial Plan. So, the menu is more than just a list of food options. It's a critical management tool that influences almost every aspect of a food service business, from planning and operations to financial control. So, the menu plays a vital role in shaping the business's success. So, a menu's ability to generate sufficient revenue and remain within budget is essential for avoiding financial failure. So, to ensure this, manager use financial evaluations and make strategic adjustments to optimize menu performance. So the menu is the foundation of any food service operation, and proper planning is crucial to its financial success. The initial capital investment needed for a food service business largely depends on the menu, as it dictates the necessary equipments, facilities, and even decor. A well thought out menu influences not only the space required, but also the atmosphere and staffing needs, ensuring they align with the overall business vision and financial goals. In addition, the guiding the design of the operation. Effective menu planning helps control costs and maximize operational efficiency. A key benefit of a well-planned menu is its ability to manage capital costs. The menu determines the type of equipment and facilities required. Some business can run efficiently with basic tools like ovens and steam jacket kettles, while others may need specialized equipment such as smokers or rotisseries. So it's important to consider the financial justification for expensive or infrequently used items. So key consideration include minimizing capital investments to maximize return while ensuring the equipment is both affordable and functional. So for many food service operations, startup costs can be significant, and operators must find a balance to ensure long-term sustainability. Additionally, payback on the capital investment is essential for continued success, whether through revenue or community benefits. So, the food service industry is often labeled as high risk, low profit, and easy to enter even without solid business experience. While the failure rate is higher than many other industries, studies indicate that 25-30% of restaurants fail, not the commonly cited 90%. So the challenges in food service operations include complex cost control due to perishable supplies, fluctuating demand, and investor hesitancy due to high failure rates. Initial capital investments can range from $500,000 to over $1 million, often requiring the operator to cover 30% of the total cost upfront. So success keys include strong financial management, understanding food purchasing and production, navigating a competitive market, and having realistic expectations about the demanding nature of the business. So, before opening a new food service operation, it's crucial to conduct a feasibility study to determine its financial viability. The purpose of the studies varies. For commercial businesses, it ensures profitability, while for institution, it ensures that the operation stays within budget constraints. So key components of a feasibility study includes a breakdown of capital investment, a plan for revenue generation, and a detailed cost estimates to go beyond rough projections. So for investors and lenders, this study is vital for assessing the potential for success. It provides the financial information needed for committing funds. So, feasibility studies are usually conducted by independent consultants, accountants, or vendors with input from marketing experts who help define the target market and promotion strategies. So, as an alternative to hiring professionals for a feasibility study, restaurant business plan software can assist in planning and financial projections. So, these tools are available for download from various vendors and typically include templates, checklists, and financial models to guide entrepreneurs through the planning process. So the software encourages users to gather detailed information, helping them gain a deeper understanding of business needs. So the advantages of using business plan software include its affordability of business needs compared to hiring a consultant, and it gives future restaurant owners a realistic sense of the level of planning required. Some software also includes pre-built financial models to make forecasting easier. So examples include master checklists, data entry forms for financial details, and tools for conducting break-even analysis and comparing income statement with national benchmarks. So this slide includes an image of a detailed feasibility study, so showing sections like market analysis, financial projections, and risk assessment. So it illustrates how businesses use these studies to assess project viability before proceeding with investments. So the image on this slide is a condensed version of a feasibility study showcasing how businesses conduct a quick evaluation before deciding whether to invest or in planning or adjust strategies. So this picture provides a visual representation of a checklist and provide guides showing the essential task for launching businesses. So the step involved is ensuring successful project execution. So the image here is a screenshot of a software interface that helps organize and track project details. So this visual aid is in the systematic collection and management of data throughout the project. So this slide displays a graphic outlining different funding sources such as loans, investors, and grants, and helps to visualize the financial options available for a business venture. So the image on this slide is an example of a statement of income, detailing revenue, costs, and profit. It helps businesses track their financial performance over time. So these pictures includes a balance sheet which represents or presents rather a business assets, liability, and equity at a specific point in time. It provides a snapshot of the financial health of a company. So the image here depicts a break-even analysis worksheet used to calculate when a business will cover its costs and start making profit. It also includes scenario worksheet for testing different variables. So the first step in a feasibility study is gathering data, which is often the most time-consuming phase. This process involves analyzing key factors like residual and commercial demand, demographics, traffic patterns, and future growth opportunities. So, key findings from the Cornell study of 2005, so target market and advertising strategies are not the most critical factors for success. So, public relations, community involvement, and customer relations play a more significant role in determining success. So, a well defined business concept is crucial. Failure often arises from losing focus or trying to serve too broad a market. So, for the concept development, so after collecting data, the new step is concept development. So, this includes designing the theme, menu, service style, hours of operation, and atmosphere of the restaurant. So, failed restaurants often lack a clear, structured concept beyond just producing food. So, a short form feasibility study is a quick assessment tool used before conducting a more detailed study. So, it helps determine if a project is worth further investment in planning and can identify adjustments that may may be needed to improve feasibility, such as expanding work service hours, such as adding breakfast, or enhancing revenue streams, such as increasing bar sales. And lastly, is adjusting pricing strategies to align with market demands. So, location is often a decisive factor in a restaurant success. A proper site analysis determines if a location can support the intended restaurant concept. So, for example, some restaurants get 95% of their patrons locally, while others rely on attracting customers from afar. So, um, location consideration is the traffic flow. So, the number of pedestrians and vehicles passing by. Next is visibility and signage. Those signs must be strategically placed for recognition. Next is the type of operation versus traffic. So, quick service restaurants thrive near transit hubs, while sit down restaurants may struggle. And lastly is parking availability. So, this is essential for highway or car dependent locations. So for environmental and market factors, so number one is the neighborhood conditions. So a deteriorating areas may deter customers, while a trendy area may attract more business. Next is for market potential. So even with an existing market, demand must still be evaluated carefully. And for the last of environmental and market factors, so is customer demographics. So income, habits, preferences, and dining behaviors all shape the demand for restaurant. And for competition analysis, compet compet competitors include other restaurants, uh, food serv food delivery services, takeout and grocery meal kits. So complementary business, such as a McDonald's next to a Taco Bell, can help each other thrive. So direct competitions may force a business out unless differentiation is clear. So for our market study question, so who are the customers and what do they want? Can you serve them at the price they'll pay? And why would they choose this restaurant? So, what are their income levels and spending habits? And who are the competitor and its market stable? So, this section explores different options for acquiring food service location, owning, renting, or leasing, along with the financial implications of each. So, for ownership, higher upfront costs but full control over land, building, equipment, and furnishing. For leasing, it offers various types of leases, including grade 4 or fully furnished to grade 1 or basic structure, with differing costs and responsibilities. And lastly is renting. Can it be fixed monthly amount or based on a percentage of gross sales? So leasing types and terms. So grade 4 lease, or also known as turnkey, it is a fully equipped and ready to operate. It usually costs higher in terms of rent. And for grade 3 lease, it includes kitchen equipments but may require additional furnishing. For grade 2 lease, it has basic interior improvements such as flooring, ventilation, and plumbing. And for grade 1 lease is a bare space that only includes basic structural elements. So for financial impact, rent usually ranges from 2 to 20% of gross sales, depending on the lease grade. Landlords may require 2 to 4 months rent as a guarantee. Lease duration is often 5 years or less, though successful businesses may secure 10-year leases. So, lease negotiation and consideration. So, clarify when lease payment starts, especially if remodeling is required. Ensure the lease structures align with the projected revenues. So this section breaks down the capital costs required to establish and sustain a food service business. So first is the initial capital consideration. So the method of establishment, such as ownership, leasing, or renting, will significantly affect capital costs. The next is pre-opening expenses. So it includes management salaries, marketing, permits, licenses, deposits, and insurance. So another thing is that liquor license can be particularly expensive and time consuming to obtain. And lastly, we have working capital requirements. So funds are needed to cover operating costs, emergency reserves, and purchasing supplies. So it's recommended to maintain a checking account balance equal to half of monthly expenses and a contingency fund for one additional month of expenses. So, food service operations financial success is determined by profitability and return on investment, also known as ROI, which are closely tied to menu pricing, cost control, and sale performance. So, profitability is a key indicator of a service operations financial health. Two common ways to measure profitability are return on assets or ROA and net profit. So ROA, um, it measures how efficiently a business uses its assets to generate profit. So, um, flash on the screen is the formula to get the ROI. So, a 3 to 6% ROA is generally considered a fair return in the food service industry. So, for net profit, so this is the amount remaining after deducting all operating expenses, interest, taxes, and other non-operating costs. So flash on the screen is the formula to get the net profit. So net profit that are that is positive indicates financial sustainability, while a negative value points to a financial struggles. So for ROI, it is a key metric used to assess profitability of a food service business relative to the initial capital investment. Flash on the screen is the formula to get ROI. So a higher ROI indicates better financial performance and more efficient use of invested funds. So investors typically accept expect a higher ROI in food service due to its higher risk compared to safer investments like bonds. So cash flow represents the actual dollars generated by a food service operation during a given period. So it's the excess cash available after operating costs are paid, and it can be used for repaying loans, covering expenses, and reinvent investing in the business. So sources of cash flow are sales revenue, additional investments, and loans. So cash flow is calculated by subtracting non-operating expenses like loan principal repayments from total available cash. So the importance of cash flow is um in cash flow versus profit. Cash flow is more important than profit because a business can be profitable on paper but still experience liquidity issues. So, in investment decisions, management must carefully analyze cash flow before making major decisions like expansion or remodeling. So, liquidity is essential for any businesses, so especially in the food service industry. So, it ensures it can meet its short-term financial obligation. So, in this slide, we'll go over key liquidity ratios used to evaluate the financial service health of food service operations. So for the current ratio, so this ratio compares current assets to current liabilities. An ideal 2 to 1 or 3 to 1 means asset exceeds liabilities. At a ratio of 1 is to 1 is acceptable but less favorable. Next is for the food service context. In food service, businesses often have a minimal account receivable. So meaning they may have a strong cash flow, but even with lower current ratio. So sales to working capital ratio. So this compares the dollar sales to working capital. So a higher ratio, such as $40 to 1 or $50 to 1, indicates efficient financial management and the ability to generate more sales with available working capital. So for the solvency ratio, so this compares the owner's equities to debt owed to creditors. So an ideal ratio of 1 is to 1 suggests a balance between equity and debt. So, 1 is to 4 ratio, however, could signal over reliance on debt, posing risk if creditors demand repayment. So, strong liquidity ensures a food service business can meet its short term obligations and continue operating smoothly. So, a favorable solvency ratio shows that a business is not overly dependent on external financing, enhancing long term stability. So, in non commercial food service operations, like those in institutional settings, and financial efficiency is still critical. So, even if the focus isn't purely on profit, there are still common ways to measure efficiency in these settings. So, first is the operating cost and the budget. So, the primary method to measure efficiency is by comparing actual operating costs and sales against budgeted figures. So, staying within the budget ensures that the operation remains financially sustainable. So, while profit may be the central goal, ensuring there's enough income to cover costs and maintain the operation is key. And lastly, is in non-commercial settings, success may also be measured by factors such as service quality, customer satisfaction, or how well the operation meets its mission. So, menu strategy plays a significant role in the financial success of a food service operation. Even small adjustment to the menu can lead to significant changes in revenue and profitability. So strategies for menu impact is to increase check average. So raising prices or introducing higher value items can boost revenue per customer. So this strategy helps increase profitability without relying solely on volume. And lastly is the lower prices and increased volume. So by reducing prices and targeting higher volume, such as offering office deliveries, you can drive more sales, particularly in areas with large business clientele. So, my personal reflection number 1, so the food business isn't inherently risky with a small profit margin. So, to succeed, you must prepare for challenges and invest time into good financial planning. So, this industry requires resilience, adaptability, and understanding of a key financial metrics. So for my personal reflection number 2, so I learned that menu affects cost, equipment, and staffing. Even small changes can have big impact on the business. So it's important to plan everything carefully. And lastly, for my personal reflection number 3, feasibility studies are really helpful in figuring out if a business idea will work. Good research can prevent mistakes and lead to success.